Everyone has sort of looked at these companies as kind of the ballast for this market. As much as we kind of see folks trying to rotate into something different, the cash generators still fall into this space here. Are we going to continue to see that type of dominance that we've seen over the past few quarters?
Yeah, hi, Roman, thanks for having me. And I think it's important to differentiate within the Magnificent Seven. So, when we're looking at more the software side of things with Microsoft and Meta and Alphabet and even Amazon, these companies are still trading on relatively reasonable valuations, obviously have very high cash flows. And they're all taking steps to deploy that either through CapEx to generate future returns. We also think we could see a lift in buybacks. We should maybe get Alphabet with $60 billion this quarter, this week, maybe even Amazon announcing one, and even some new dividends coming through. So we're starting to see more of that cash flow, coming back to shareholders, which is also helping valuations.
What are you going to mainly be looking for out of this batch of earnings here? It's not just about the numbers. I know there is a broader narrative, whether it's around AI or some of the other big tech transformations taking place here. What's going to be most important to you?
Yeah, I think this week investors are going to be focused on three things. One is cloud computing. I know we talk about it every quarter, but Microsoft Azure, Amazon Web Services, Google Cloud, are they continuing to reaccelerate? Are we seeing that AI demand actually coming through and that CapEx converting into revenue for these companies? The second thing is on the digital advertising side. We saw better data points as we went through the quarter. So we're going to see that reflected in Google and Meta's numbers. Those fundamentals are important because growth will slow. Comps are getting tougher. So we want to make sure that the fundamentals are still intact. And the third thing, as I mentioned before, is capital allocation. Are these companies still being prudent about investing? Are they going to be paying more in terms of buybacks and dividends? And could M&A creep in? We've heard a few reports, obviously, from Alphabet to Salesforce considering M&A. Is that something that's really on the table?
The Magnificent Seven doing most of the heavy lifting for the NASDAQ. Amazon hitting an all-time high. NVIDIA gaining more than 4%. For more on the tech sector and internet stocks in particular, we are joined by Mark Mahaney, Evercore ISI, head of internet research. And Mark, you are seeing, the NASDAQ really picking up. And again, it's those big stocks that are doing it. Why don't we start with Amazon? Because I think that's your best long-term call for large caps. Is that correct?
That's right. It's our number one pick in the internet space.
Why?
Well, we think we had a little bit of an inflection point. So we think we have three fundamental catalysts this year. We're going to have the reacceleration in AWS growth. We're going to have the attainment of record high retail operating margins. And I think in that shareholder letter yesterday and in the interview with Andrew, I think we got a couple of new data points to that. And I think for the company as a whole, I think we're going to have record high free cash flow margins this year. So when you have that kind of come together, I think you get a little bit more of a re-rating in the stock. You put 25 times free cash flow on next year's numbers, and you get something like a 220 stock price. This could go to 25, 30 times free cash flow for an asset that can probably grow free cash flow at 40%. I think that's reasonable. You could get up to 250. So we think there's valuation support. Of all the internet stocks, there's very few dislocations left, frankly. But I think Amazon is still one of them, still high quality asset. It's our number one pick.
When we talk about artificial intelligence and the companies that are achieving remarkable results with it, no other companies can compete with the Magnificent Seven, as all seven are helping shape the AI narrative in their own ways. And one prominent player of the Magnificent Seven is Amazon, which is viewed as one of the best AI developers among mega-cap tech companies with long-term growth prospects that look as good as ever. In today's video, we will talk about some analysts, a billionaire's hedge fund, and investment advisory firms who recently went all in on Amazon stock thanks to the company's positive outlook on its stock performance and promising estimates for the upcoming earnings report next week on the 30th of April. But before we do that, if you want to keep up with Amazon's latest updates and keep up with the stock market's latest news, you can follow our Twitter account. We post multiple times daily about the biggest changes and catalysts in the market, so click the follow button if you don't want to miss the newest market updates. Now, back to today's video.
Our next guest says Amazon is his top mega cap pick. Gil Luria is a senior software analyst at D.A. Davidson, has a buy rating, of course, as you might expect. Target's 235. That is the highest on the street. Hey, Gil, give me your take on the letter. I hope you watched the interview as well. Just anything stand out to you from either one of them?
Well, I think the letter goes through a very great detail about Amazon's approach, the fundamental-based approach. They call it primitives, The reason it's important at this point in time is that that's how they're approaching generative AI. They're not trying to provide a holistic solution or a singular internally built solution. They want to provide all the building blocks, from chips to models to middleware to applications, and allow their customers to take different pieces that they need in order to create the solutions that they want to use. This is a very important approach because it positions them to catch up to Microsoft Azure. Microsoft is getting all the credit for delivering AI applications and services. Amazon is getting very little credit, and in spite of the fact that AWS is the bigger business, and they're doing a lot to catch up.
So, fair to say your optimism is centered largely on what you believe is what will be the success of AWS?
Yes, absolutely. This is the most important business. It's re-accelerating this year, not just based on generative AI, which I think is a case, but also other types of tailwinds. Enterprises have stabilized in terms of trying to cut down costs. The acquisition of VMware by Broadcom has actually made the market a lot better because it's causing their customers to reconsider what they have on premise and what they're shifting to the cloud. So they have a variety of tailwinds at the AWS business that should play out this year, while the retail business is going to do well, increase margins, but the AWS business is going to really be the driver for this year.
So first off, we have the investment advisory firm Ithaca Group, which recently released the Ithaca US Growth Strategy Q1 2024 investor letter. It featured stocks like Amazon and explicitly stated that the company would be able to contain expenses and push operating margins above prior peaks in the near to medium term. It also mentioned that Amazon Web Services has become the market leader in outsourced cloud infrastructure, which approves of Amazon's initial efforts to enhance their position in the AI market. It also spoke about Amazon's growing advertising business as a great catalyst for Amazon stock, saying that Amazon advertising is garnering a significant share in digital advertising, particularly product placement ads, thanks to consumers beginning their product searches on Amazon's site. And they're very right to be bullish on Amazon's advertising business, as it made the company $14.6 billion in the last quarter, an increase of 27% year over year. So that was the Ithaca Group's view on Amazon's stock and how it will perform in the near to medium term, indicating how bullish they are on the company. Additionally, billionaire Ken Griffin's hedge fund Citadel, which holds shares of all of the top technology stocks, recently acquired a stake in Amazon stock. There's a reason why some investors choose to pay close attention to the stocks Griffin is buying, and that's because he has made many winning bets over time, and investors have figured that they could also benefit from some of his moves. For instance, Citadel has generated about $74 billion in total gains since its inception in 1990, and for last year alone, Citadel managed to bring in more than $8 billion, which prompted LCH Investments to name the hedge fund among last year's top performers. This brings us to Griffin's most recent move, which was more than doubling his holdings of two Magnificent Seven stocks, with one of them being Amazon. Citadel lifted its position in Amazon stock by 227% in the fourth quarter, buying more than 4 million shares, which makes Amazon its fourth biggest position, so it's safe to say this is one of Citadel's favorites. In fact, Amazon has been a big winner for Griffin and Citadel, as its shares jumped by more than 200% during the first period when it was in the hedge fund's portfolio. Now, the stock is up by more than 300% since the end of 2017's first quarter. Griffin must have had AI on his mind when he bought more Amazon shares in Q4, and in particular, the generative AI boom and how it could provide a huge long-term tailwind for AWS. Bloomberg forecasts that generative AI will be a $1.3 trillion market by 2032, and this could be a great opportunity for Amazon as the AWS launched its Amazon Bedrock service last year to help organizations rapidly build generative AI apps in the cloud. They also have their powerful AI assistant, Code Whisperer, a tool that generates code suggestions to range from snippets to full functions. This will be a game changer for developers looking to accelerate their productivity and bring projects to market faster. In addition to that, Amazon Q is another powerful generative AI assistant to rival softwares like Microsoft's Copilot. Additionally, Amazon is one of NVIDIA's major customers and uses its GPUs extensively, even though it has also built its own AI chips, which shows how much the company believes that AI is what will drive its growth going forward and how important it is for the company to have the newest tech available. Moreover, Bank of America securities analyst Justin Post is also extremely bullish on Amazon. He reiterated a buy rating on Amazon with a price target of $204, which is an upside of approximately 14% from where the stock is trading as of the time of this video. He expects Amazon's first quarter earnings to reflect positive trends with a revenue forecast of $143 billion, closely aligning with market expectations, which amount to $142.5 billion. And he added that the focus will be on potential upside from AWS and advertising. So, why are so many hedge funds and analysts so bullish on Amazon stock? Let's find out. Hello everyone, and welcome back to Investocracy.
If I just pivot back to Amazon, I mean, this is a company that can win a couple of different ways. It improves products and processes on the retail side of the business. It helps the ad targeting, ad creation. That was kind of an interesting point that came out yesterday. And then on AWS side, the Gen AI revolution is not going to be televised. It's going to be on the cloud, and somebody's going to need to store it. Somebody's going to need to compute it. And AWS, is very hard to see anybody doing more compute, more storage with Gen AI than AWS.
The other huge advantage they have is the infrastructure they've built up just on the retailing side. I mean, Andy Jassy laid it out in his letter, the idea that they can deliver 7 billion items same day. I mean, that is something that's pretty hard for anybody else to surmount.
So there's two really key points here, Becky. One is that they built these moats around their business. I mean, this is their competitive advantage. It's logistics. They can serve an item that is, go from click or click to your doorstep more cheaply than anybody else can. And that means they can also do it faster than anybody else can, too. What an advantage. So you mentioned the 7 billion number, but now where you are in the kind of investment cycle, they're in harvest mode. So that dramatic investment cycle that really crushed the stock or really caused the stock to underperform for 2 or 3 years, you're on the backside of that now. So you're going to have that number that they gave out yesterday, that for the first time since 2018, you're starting to see the cost per ship or cost to deliver decline by about 45 cents. You're going to hear that again, I think, next year and the year after that. That's where you are in the cycle. That means that margins are going to be rising for this company. It's a great spot for investors to be in. You're on the other side of the investment cycle.
Right now, Amazon could benefit from AI in two ways, and both might supercharge earnings over the long term. Firstly, Amazon is using AI to become more efficient and lower its costs. For example, in e-commerce, AI helps determine the fastest delivery routes for package delivery, which reduces travel time and costs. On top of that, it is also using AI to help customers find the right items and see the right ads that are suitable to them, and this contributes to the customers being more likely to return to the platform for their shopping. Secondly, Amazon's cloud computing business, which sells AI chips and related products and services to customers, increases the chance of Amazon winning big. AWS has access to an enormous client base, and it's actually the biggest cloud company in the world. AWS is going all in on AI, offering not only chips but also a fully managed service that gives customers access to popular large language models that they can customize for their own purposes. This means that AWS may serve a broad range of AI customers, and as the demand for AI applications rises, AWS will play a crucial role in Amazon's longer-term growth.
Let's go to our newsroom. Renita Young, our senior markets correspondent, with a developing story that seems to be bad for Instacart. Amazon gonna deliver again? For what kind of deal are we talking here, Renita?
Oh, we're talking about grocery delivery, and Amazon Fresh is pretty much coming for Instacart's market share. They started to roll out 2 different grocery delivery services for Prime members. So if you already have a $14 a month or $139 a year Prime membership for groceries, you can get the $9.99 membership, or if you're an EBT customer, a customer who uses the electronic benefits transfer, you can get that grocery delivery service for $4.99 a month over at Amazon Fresh. And that'll include unlimited delivery from from Amazon Fresh and Whole Foods orders, deliveries of more than $35 will be included in that. It also includes 1-hour delivery windows at no extra cost and unlimited 30-minute pickup on orders of any size. And it'll also give you priority access to recurring reservations for a weekly grocery order. Maybe you need your produce just that fresh to come every week. But listen, if this sounds kind of familiar, it's because Amazon has formerly offered free delivery for groceries. Remember that, Oliver? Once upon a time, Prime members got free Amazon Fresh delivery and free Whole Foods delivery for orders more than $35. But back in 2021, Amazon actually added a $9.99 delivery charge for all Whole Foods orders, and it met with such opposition that it came with a lawsuit by some customers. And it also, the company, Amazon, has also raised and dropped grocery delivery fees, that threshold for however much it'll cost, if it'll cost free or more. They've dropped and raised that threshold several times over the past few years. Now, this is all, of course, hitting Instacart pretty badly today. Now, Instacart has become one of the biggest in the industry, even though Amazon Fresh is considered the OG in this situation. It's been delivering groceries since around 2007. Instacart has been delivering since 2012. But Instacart has a $99 a year membership or $9.99 a month, and members can get the unlimited or free delivery on orders that are above $35. So it's not unlimited free delivery for any order, just that above $35. And they do actually still charge service fees of between 5 and 10%, but they also have perks like a 5% cash back perk, among others. So
sounds like they got cut. Sounds like Amazon just undercut them pretty
big
clearly, right?
Absolutely.
I mean, why would, if you had the choice, plus you've got all the other benefits of Amazon too, I guess, right? You
do. You get all the other benefits of Amazon, i.e. having free delivery or reduced delivery for the other items that Amazon delivers from the storefronts, not storefronts, but you know what I'm talking about, from the locations, the warehouses. That's what the word is.
With that being said, Amazon is not planning to depend on AI only, as it also keeps investing a lot of money to enhance its e-commerce business. As we've seen in the video, Amazon recently launched a new grocery delivery subscription, which will be available in over 3,500 cities and towns across the country. The company's move comes as part of the efforts to expand its fresh food business and to further improve its e-commerce business. And all of these efforts on both aspects, the AI and the e-commerce business, will definitely improve Amazon's performance, increase customer satisfaction, and help the business grow. If you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
He also talked about cost cutting in the letter a bit, said that the company remains committed to it, said that they've challenged every closely held belief in our fulfillment network, reevaluated every part of it, and found several areas where he says we believe we can lower costs even further while also delivering faster for customers. How much room is there left to cut?
Well, there's always, if Amazon's taught us anything, is that there's always more room. They've been able to reduce the cost of fulfillment and delivery and the whole supply chain every year, and they're going to continue to do that, which extends their lead in the retail business. But the other thing that's important there is visibility into margins. In the past, Amazon hasn't been consistent in delivering margins, especially in the retail business. And the fact that they're talking about continuing cost cuts tells us that they're at the very least willing to sustain these margins, while at the same time AWS is growing at higher margins.
Finally, to your price target, given we're talking about the stock, 235 is 18.2 times calendar year 25 EBITDA numbers. Why is that an appropriate multiple in your opinion, given it certainly is at the higher end of the range at which Amazon is traded?
Well, that's right. They have an accelerating business, but I would just, to crystallize what's going on right now, I would just step back and say, if you could choose between $100 billion hardware cyclical business or $100 billion leading software business, which one would you pay for? Right now, NVIDIA's market cap is higher than all of Amazon, I would say that I'd rather own the big leading software business and have the retail subscription advertising business thrown in for free.
With the company's earnings report around the corner on April 30th, investors will be eagerly watching for Amazon's performance. Analysts expect that Amazon will post earnings per share of $0.82, which would mark year-over-year growth of 164.52%. Simultaneously, the latest consensus estimate expects the revenue to be $142.5 billion, showing an 1191% escalation compared to the year-ago quarter. As for the full fiscal year, the Zacks consensus estimates forecast earnings per share of $4.10 and revenue of $641.49 billion, indicating increases of over 41.38% and over 11.61% respectively compared to the previous year. So, all of this is more reasons to be bullish on Amazon stock and the company's performance over both the short term and long term. And it's not just us saying this, because the majority of Wall Street analysts are optimistic about Amazon stock. In the last 90 days, 62 analysts covered the stock, with the majority of the analysts, 45 to be exact, giving a strong buy rating on the stock, while 15 analysts gave a buy rating. Amazon will continue to hold the dominant market share in the cloud infrastructure market, and since demand for cloud services will continue to skyrocket with AI being the primary driver, Amazon stock seems like a no-brainer investment, as AWS is extremely well positioned to meet these needs. So, what do you think about Amazon stock? Will you be buying before earnings? Let us know your thoughts in the comment section, and don't forget to tell us what your valuation for Amazon is. If you would like to know more about the latest updates about companies like Amazon, then go ahead and click on the next video on your screen. See you there.